without even realizing that your so-called passive strategy has become a partial bet on a narrow group of companies delivering an almost flawless future. That is the hidden buyer behind the AI trade. It is not just hedge funds. It is not just retail traders. It is not just tech bulls. It is retirement money, benchmark money, passive money, mechanical money, your money. And that is why this matters. Because in modern markets, you do not always choose the bubble. Sometimes the bubble chooses you. The biggest risks are rarely the loudest headlines. They are usually hiding inside the boring machinery everyone takes for granted. Index construction, fund flows, benchmark pressure, rebalancing, and the automatic buying that happens while everyone is busy arguing about whether AI will change the world. Maybe it will. But the market's real question is not whether AI changes the world. The question is whether your portfolio is already paying too much for that world before it arrives. And if you want to understand markets through the mechanisms actually moving money, not the headline fairy tales designed for people who enjoy being financially sedated, subscribe to the channel, because the next bubble may not start with you pressing buy. It may start with your retirement account doing exactly what it was designed to do. You are buying the AI bubble, whether you like it or not. Everybody thinks the AI bubble begins when some overexcited investor opens a brokerage app, sees a chip stock up 200%, and decides, with the calm rationality of a raccoon in a casino, yes, this is where my money belongs. But that is only the part you can see. The real problem is more boring, more mechanical, and honestly, more dangerous. Because you may never buy a single AI stock on purpose. You may not care about semiconductors, cloud margins, GPU supply chains, data centers, or whatever new acronym Wall Street is pretending to understand this week. But if you own an S&P 500 index fund, a Nasdaq ETF, a target date retirement fund, a 401k, an IRA, or any passive product tied to the major indexes, you may already be buying the AI trade. Not because you chose it, not because you analyzed the valuation, not because you sat down with a cup of coffee and said, you know what my retirement needs? More exposure to companies priced like they already own the future. You are buying it because the system tells your money where to go. And that is the part almost nobody talks about. The public story is simple. AI is a revolution. The biggest tech companies are the winners. Productivity will explode. Data centers will multiply. Software will become smarter. Chips will become the new oil. Every business will eventually pay tribute to the algorithmic overlords. Apparently because we have decided subtlety is no longer part of capitalism. So the market gives these companies massive valuations because the future is supposed to be incredible. That story might even be partly true. But markets are not just moved by stories. Markets are moved by rules, index rules, ETF flows, benchmark pressure, rebalancing, options hedging, retirement contributions, passive money. That does not ask whether a stock is cheap, expensive, or priced for perfection. It only asks one question. What is this company's weight in the index? And how much do I need to own? That is where the AI trade gets interesting. Because active investors buy because they believe, passive investors buy because the formula says so. And when the formula keeps directing more money into the same handful of enormous AI-linked companies, the price can move not only because the fundamentals are improving, but because the structure of the market is creating automatic demand. To understand why, we need to start with the least exciting phrase in modern finance: market cap weighting. A market cap weighted index sounds harmless, almost elegant. The biggest companies get the biggest weights. Smaller companies get smaller weights. You buy the index, you own the market. Simple. And for decades, this has been sold as the grown-up investing answer. Don't pick stocks. Don't time the market. Don't pretend you are smarter than professionals who also are not as smart as they think. Just buy a low-cost index fund and let capitalism do the work. That is not bad advice. But there is a hidden mechanism inside it. In a market cap weighted index, when a company's stock price rises, its market value rises. When its market value rises, its weight in the index rises. When its weight in the index rises, every fund tracking that index needs to own more of it to stay aligned. So the sequence is very important. Price goes up, index weight goes up. Passive funds allocate more money. That buying can support the price. The higher price increases the weight again. Then more passive money follows. This is not a conspiracy. It is not a secret meeting in a dark room where people in fleece vests decide to make your retirement account buy expensive tech stocks. It is just math. Unfortunately, in financial markets, math sometimes behaves like a drunk bulldozer. Now, add AI to this machine. When a small group of AI-linked megacap stocks rises much faster than the rest of the market, their share of major indexes increases. That means every dollar flowing into broad market funds increasingly tilts toward those same companies. Every paycheck contribution into a 401k, every automatic monthly investment into an index fund, every target date fund purchase, every retirement plan default allocation, every investor saying, I don't want to pick stocks, I just want to own the market. A growing chunk of that money goes into the biggest stocks in the index, and if those biggest stocks are also the AI winners, then congratulations, you are in the AI trade. You may not have chosen it, but the index chose it for you. That changes the question. The question is not simply, do investors believe AI is worth this much? The better question is, how much money will keep buying these stocks regardless of valuation? That is the part missing from the headline. The headline says, AI stocks rise on optimism. Nice, clean, completely digestible. Perfect for people who want finance explained with the emotional depth of a weather report. But underneath that headline is a more mechanical reality. Some buyers are buying because they are excited. Some buyers are buying because they are benchmarked. Some buyers are buying because they are underweight. Some buyers are buying because the index composition changed. Some buyers are buying because options, positioning forces hedging. And some buyers are buying because their retirement contribution hit the fund on the 15th of the month and the machine did what the machine does. This brings us to the first domino, index concentration. A broad market index can look diversified on the surface while becoming increasingly dependent on a small group of stocks underneath. On the label, you own the S&P 500. In practice, a large share of your returns can be driven by a handful of megacap companies tied to the same theme: AI infrastructure, cloud computing, chips, software platforms, data centers, and the promise of future monetization. That number matters because owning the market does not always mean what people think it means. If a few companies dominate the index, then your index fund is not some perfectly neutral basket. It becomes a machine that allocates more capital to yesterday's biggest winners. Again, that does not automatically make it wrong, but it does mean the risk is not evenly distributed. You think you bought diversification. What you may have bought is concentration wearing a fake mustache. The second domino is the passive investor who thinks they are neutral. Meet Bob. Bob is not a trader. Bob has a job. Bob has a family. Bob does not wake up at 5:30 in the morning to read semiconductor supply chain notes like some kind of caffeine-powered goblin. Bob does the responsible thing. He contributes to his 401k. He owns a target date fund. Maybe he has an S&P 500 ETF in a brokerage account. He ignores financial television, which is probably the healthiest decision he has made all year. Bob thinks he is avoiding the madness. But Bob's money is still flowing into the market through passive vehicles. And those passive vehicles are buying according to index weights. If AI-linked megacaps dominate the index, Bob owns more of them. Bob did not choose the AI trade. The AI trade chose Bob. It is beautiful, really. Like a romance. Except the other person is a valuation multiple, and it may ruin your retirement assumptions. This is the core contradiction of passive investing. Passive investing is marketed as a way to avoid making active decisions. But the index itself is still making allocation decisions through its construction. Market cap weighting rewards what has already gone up. The bigger the company becomes, the more money tracks it. The more money tracks it, the more important it becomes to IR it is for professional managers to ignore. Which brings us to the third domino: benchmark pressure. Active managers are not immune to this. In theory, active managers can say, "This stock is too expensive. We will not buy it." In practice, if a stock becomes a massive part of the benchmark and keeps rising, refusing to own it can become career risk. If the stock goes up and you do not own it, you underperform. If you underperform long enough, clients leave. If clients leave, your thoughtful valuation discipline becomes a very elegant way to become unemployed. So even active managers can be pulled into the same trade. Not always because they love the valuation, but because the benchmark is dragging them there. This is how a market theme becomes self-reinforcing. Passive funds buy because the index says so. Active managers buy because they cannot afford to be too underweight. Retail investors buy because the chart is going up. Options traders pile in because momentum is working. Dealers hedge flows in ways that can amplify price moves. Analysts raise price targets because nobody wants to look like the last person still using a calculator. And the whole thing begins to look like fundamental confirmation. The stock goes up, so people say, the market must know something. But sometimes the market does not know something. Sometimes the market is just a giant plumbing system with money flowing through pipes that nobody on television wants to explain because retirement account forced exposure through market cap weighted index mechanics is not exactly a sexy chyron. Now, to be clear, this does not mean AI is fake. That is the lazy argument. A bubble does not require the technology to be fake. The internet was real, the railroad was real, radio was real, personal computers were real, cloud computing was real, housing was real. The problem in bubbles is not always that the story is false. The problem is that the story becomes so attractive that investors stop asking what price already assumes. AI may genuinely transform the economy. It may change software, advertising, healthcare, manufacturing, finance, education, logistics, defense, and probably several industries that currently think they are safe. Because executives love learning things late. But investing is not about whether a technology matters. Investing is about what price you pay for that future. A great company can be a terrible investment if the price already assumes perfection. That is valuation gravity. When expectations are reasonable, companies can make mistakes and survive. When expectations are euphoric, even good results may not be enough. Revenue can grow, margins can expand. Guidance can be solid, and the stock can still fall because investors had priced in something closer to divine intervention. That is the danger with the AI trade. Not that AI will disappear, but that the market may be discounting too much, too fast, with too much money crowded into too few names. And when crowding builds through passive flows, benchmark pressure, and options activity, the same machine that helps prices rise can make the reversal uglier, because feedback loops work both ways. Imagine the narrative cracks, not collapses, just cracks. Maybe AI CapEx slows. Maybe data center spending grows, but not fast enough. Maybe cloud margins come under pressure. Maybe customers experiment with AI tools but do not pay enough to justify the spending boom. Maybe regulation becomes a problem. Maybe competition turns pricing power into a knife fight. Maybe earnings are good, but not good enough for stocks priced like they have already conquered the next decade. Then the first big AI winner falls. If it is large enough, the index falls. If the index falls, volatility rises. If volatility rises, risk models adjust. If momentum turns negative, trend-following strategies may sell. If options positioning shifts, dealer hedging can add pressure. If active managers are overweight, they may cut exposure. If retail investors see their safe index funds dropping because 5 stocks are doing the emotional equivalent of falling down stairs, they may finally discover what concentration risk means. And that is the reverse domino chain. On the way up, everyone calls it innovation. On the way down, everyone suddenly discovers market structure. Amazing how that works. This is why the phrase, "I don't own AI stocks," may be less true than people think. If you own a broad market index fund, you probably own them. If you own a target date fund, you may own them indirectly. If your 401k default option holds large cap US equity exposure, you may own them. If you own a Nasdaq 100 ETF, you definitely need to look under the hood. The issue is not whether you should panic. Panic is not a strategy. It is just market timing with worse posture. The issue is awareness. You need to know what you actually own, not what the fund name suggests, not what the marketing page implies, not what your brain filed away as safe retirement stuff. Look at the top holdings. Look at sector exposure. Look at how much of the fund depends on the same handful of companies. Look at whether your diversified portfolio is actually one giant bet on US mega-cap tech, continuing to exceed already enormous expectations. Because there is a difference between owning the market and owning the part of the market that has already won. There is also a difference between long-term investing and blindly accepting whatever concentration the index hands you. This is where people get defensive. They hear criticism of index concentration and assume the answer is to abandon passive investing entirely. That is not the point. Low-cost indexing can still be a very powerful tool. For many people, it is better than stock picking, market timing, and listening to someone on the internet who says generational opportunity every 6 weeks. The point is not that index funds are bad. The point is that index funds are not magic. They have rules. Those rules create exposures. Those exposures create risks. And those risks become more important when a small group of companies becomes a large share of the market. So what should you actually take away from this? First, separate the technology from the stock. AI can be transformative while AI stocks can still be expensive. Both things can be true at the same time, because reality is rude like that. Second, understand the mechanism of forced buying. When a stock rises, do not assume every buyer is making a fresh fundamental judgment. Ask who is forced to buy. Index funds, benchmark-sensitive managers, momentum funds, options, hedgers, retirement flows. Third, check your own exposure. If your portfolio is mostly US large-cap index funds, you may have more AI exposure than you think. That does not automatically mean sell. It means stop pretending you are neutral when your portfolio may be heavily tilted toward one theme. Fourth, respect valuation gravity. The higher the expectations, the less room there is for disappointment. In markets, the future can be bright and the investment can still disappoint if too much of that future is already priced in. And finally, remember the historical pattern. Every generation thinks its bubble is smarter. This time, there is better technology. This time, the companies are profitable. This time, the balance sheets are stronger. This time, the winners are real. Sometimes all of that is true, and yet, the price can still be wrong. That is the uncomfortable part. Bubbles are most dangerous when they are built around something real. Because the real story gives people permission to ignore the price. So when someone says, "I'm not participating in the AI bubble," the right answer is, "Are you sure?" Because if you own index funds, retirement funds, target date funds, or broad market ETFs, you may already be participating quietly, automatically, every month, without reading a single AI earnings transcript, without buying one individual stock.